Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for chartsandmarkets.com. He's speaking to us from Vancouver. Welcome back to the show, Bob.
Yeah, hi, Jim. Always good to be with you and our listeners on Fridays, and here we are.
Bob, we love to take listener questions. Our first one comes from Tony. He asks, Bob, do you think Stephanie Kelton and modern monetary theory have won, at least for now?
Oh, well, that's a good question. Modern monetary theory, or as they shorten it to MMT, is a very strange idea that the government can pump out as much currency and credit as they want and need, and that their activities will offset that and won't cause inflation. It's utter nonsense. It's just a new twist on an old story about injecting too much currency or credit into the financial markets, and it's been a bit of a fad among certain intellectuals. I think those of us professionals in the investment business know that it's just another bit of nonsense. And but what you have is that one started to float around a couple of years ago, and what you have now, of course, is that with commodity prices advancing over the last year, our take on it is that this is so with the business side of the boom of a great financial bubble, and when in the past commodities got up under such circumstances. But they really become kind of a rotation, and there's only a couple that are still making new highs, but you had only not so many weeks ago natural gas, aluminum, the Baltic freight rate, yeah, we're calling it a commodity. We're going straight up, became technically excessive, and have taken a rather severe hit. So the MMT story is nonsense. It's just a front for the age-old urge to inflate. And the story about now inflation is going to run for some time is probably burning itself out fairly soon here now. So, but good points to bring forward, Tony.
A question from Michael. Hi, Jim and Bob. Bob, it seems like gold is breaking out to the upside along with the U.S. dollar. How can both be going up at the same time since they're supposed to be inversely related? Assuming a final market peak is upon us, is there a scenario where gold rises as a safe haven while silver and the gold miners sell off with the overall stock market?
Yeah. Michael, very good question. And my colleague Ross Clark yesterday published a piece reviewing the periods in the past when you've had gold rallying as the dollar firmed. It can happen, and the way I've quipped about it is that when you're going into a post-bubble contraction, the really careful money goes to the most liquid items, which is treasury bills in the U.S. dollar and gold. Fair liquidity there as well. So then you have, at certain periods, perhaps in anticipating a contraction, a time when there's a bid for the dollar, for the treasury bill, and there's a bid for gold. So it's happening now. But the conclusion from this study is that often the condition has not been long, and it's preliminary to gold going up. No, sorry. Preliminary to the dollar continuing its rise, and in which case you're going to get a correction in gold. And as my own work is bullish on the dollar, and this week the DX trading at 95 is really extending the uptrend in the dollar. Thanks for the question. Oh, what was the other part? Yeah, safe havens.
Yes.
So, yeah. Yes. Here's the other part. In a post-bubble contraction, gold's real price goes up because so many people are positioning it, and there are so many commodities and everything else falling relative to gold, that as the gold's real price goes up, it reflects improving operating margins for gold miners, whose costs, wages and cost of energy, would be going down once the contraction's underway. So this is where we're apprehensive at the moment on gold and gold stocks, but bullish on the long term, and are looking for a correction in gold stocks here over the next few months, and that then would lead to a really terrific buying opportunity. And Michael, thanks for the question.
Our next question comes from Chris, and Chris asks, "Hi Bob, really enjoy the show. Do PE ratios, and what's a PE ratio?"
That's the price earnings, where you take the earnings per share and compare it to the price of the stock. And when you're in a crazy financial bubble, the PE goes very high, so valuations are high. And then actually in a bear market, often the earnings disappear very quickly, such that the PE goes even higher. So, but when you're in this kind of a mania, the standard valuations of price earnings or the valuation against book value just become meaningless. It's disturbing to look at them. And what you want to do is just look at the action in individual sectors or stocks, looking for technical excesses and making your positions based upon that. So,
Bob, I'll read out the entire question.
Yeah.
Because
I
believe you pretty well covered everything.
Yeah.
Do PE ratios mean anything in predicting market direction? Everyone uses it as a rationalization after the fact for market moves up and down, but they sure don't seem to matter for long periods of time. Do they measure market tops or bottoms well? Are they useful indicators at all? If not, what is a good measure of critical points of over or under valuation in the markets?
Yeah. Yeah, we did cover that, but we'll just do a little wrap on it, Jim, that yes, the valuations don't matter in a crazy bull market, but what does matter is the technical excesses. Now, our tools include on this kind of thing where specific sectors or index will be getting what we call upside exhaustions, and that model relates to kind of a momentum determination. And then we use another one that gives at important highs what we call sequential sells, and that is not based upon momentum but based upon pattern. So when you have two independent models, each saying technical excesses, upside exhaustions, which we're getting on some sectors, or having the sequential sell. It's a terrific way of determining a potential high. Now, also to show impartiality, we have the opposite on each of those models, and on the momentum-based one, it's called a downside capitulation, where you're heading for a bottom, and then also on the pattern side, it's called a sequential buy when we get one of those. Now, sometimes at important lows, we will get both readings as a bottom is being set. So it's been very helpful to have these disciplines. Yeah, let's call them technical disciplines. And thanks very much for the question.
Question I have, and this was pointed out by the friend of the show, Danielle Park, that long-term, we're talking 20-year Treasury bonds. Now, we have an inversion of the yield rate between the long and short-term, very long rates. And, Bob, the last time this happened, you said this is a hint that a recession could be 9 months down the road. Are we facing a recession 9 months down the road, or do 20-year Treasury bills count?
The yield curve in the last year or so has been erratic. It's not doing what it usually does at a potential cyclical peak for the stock market. And I've got the yield curve in the U.S. going back to, I think, 1860. I know that it covers the 1873 bubble, the 1929 bubble, and all of the bull markets in between. And the rule is that if the yield curve inverts, like gets fully inverted with short rates higher than long rates, a recession will follow. Now, the last time the curve inverted was in 2019, and then you had the COVID crash in 2020, and they then put on a brief recession there. But at the time we made the call in January 2020 that the yield curve inverted and a recession was possible, but had no idea. That was before the panic started and the authorities around the world shut down the economy. So that was sort of weird, and I'll get myself updated on it. But at the moment, the portion of the yield curve we're looking at, the pattern over the last year or so has been choppy and not signaling anything, but perhaps something may occur in this line on the portion of the curve we look at, which is, from 6 months out to the 20-year. And there's all kinds of ways of looking at the curve. You can go from the 2s to the 20s if you want. But anyways, it's Jim, I appreciate your question, and it is to the point. And at the moment, my conclusion is that the yield curve is choppy, but we'll watch and see what it brings over the next few weeks.
We'll have more with Bob Hoye right after this.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Bob Hoye. Bob, President Biden's response to inflation is to order his economic council to reduce energy costs. Isn't this the president who the very first thing he did was cancel the XL pipeline that would have brought cheap Alberta oil into the heartland of the U.S.?
Oh, yeah, and then also he moved very quickly to shut down oil and gas exploration and development on federal lands. Of course, it can still go ahead on private lands, and of course it goes back to Obama when he said that under his plan, energy costs would necessarily go up for the betterment of CO2. So then Biden comes in with a knee-jerk move and shuts down as much as possible. It's not just Biden. The federal government in Canada is shutting down as much resource business as they can. So naturally, prices have gone up, but it's also part of the boom, of the financial boom out here. So, it's actually absolutely absurd policy from the administration.
In British Columbia, housing affordability is a big subject, and wood is a big part of that. But the BC government's new logging policy will shut down 22 mills, sawmills and pulp mills, and perhaps throw at least 20,000 people out of work, which means, in the long run, to build a house in BC, we may end up importing lumber from South America, which will mean cutting down the rainforest, which is not replanted like the forests in BC are. Right after a tree is cut down, the first people in are the reforesters to plant new trees.
Oh, yeah.
So, Bob, is this a very short-sighted policy on the part of the BC NDP to gain the votes of the urban people who probably wouldn't know a sawmill if they had one parked in their front yard?
Yeah, it's political madness. Absolutely political madness, and it just has to, unfortunately, the only way you can get rid of political madness is when hardship becomes so severe that the public looks at their personal hardship, and looks what the government did to them and said, enough, and then votes in a more practical government. And it can and it will happen. But in the meantime, it takes severe hardship to break the spell of political madness that we're now enduring. So,
another headline that caught your attention today: the madness of taxing unrealized capital gains.
Yeah, that one's out of the States, and the Biden administration, being completely Marxist, wants to control all of the wealth in the country and then be magnificent in allowing dribs and drabs to get out to ordinary folk. So capital gains tax is bad enough, but here they're going to tax it on with no realization of capital. They're just plain wealth tax. Let's call it confiscation, which is what it is. And then, of course, the other thing is deliberate policies of currency depreciation is also another form of state theft. So this is evil stuff, and it's now so radical, so bizarre that it's got to be close to ending action, Jim. So hopefully.
Chinese junk bond yields now top 25% as the property market there sees its problems intensify. And a headline that just hit my cell phone actually said, China's Evergrande avoids default for the third time in a month with a last-minute cash scramble. But, of course, people are super nervous now about that. So what's the story behind these junk bonds?
Yeah, Jim, that headline about 25%, when I first started reading the article, I thought, oh, my gosh, that's the yield for Evergrande bonds. It's an individual bond that is gone up to 25% yield. The breakout was last June at 10% yield. And so, that was when I looked at the chart. And no, it is the yields for Evergrande and some others. There's another company has suddenly stumbled, and it's Kaisa, Kaisa. But no, the 25% yield is an index of Chinese junk bonds. And as I said, the breakout last summer, maybe a year and a half ago, it was at 7%. Then the breakout in last summer was at 10%, and now it's at 25%. And so my surprise was what I thought was an individual bond in distress is actually an index of I don't know how many, but represents the whole of the junk bond market in China, and it is turning worse. And when you have a financial distress being discovered in outlying countries, it inevitably goes back and hits the world's financial centers, such as New York and London. That will happen at some time. There's an inevitability to it, and hopefully we can get the timing on it. But having a junk bond index at 25% yield is very important.
That reminds me of 1981 when the Canada Savings Bond paid 21%. But I think a Canadian Savings Bond is a whole lot more of a stable investment than a Chinese junk bond.
Well, that was because the yields and everything with that period of consumer price inflation, like the long government bond, Canada got up to 19%. And in the U.S., their long treasury got up to, I think it was about 15%. So that was extraordinary because in the past 300 years, and using England as the example historically, that at times of great distress in the financial markets, the yield for long government bonds would get up to 6, or maybe in extreme distress, 6.5%. And here you had, in the world's senior economy, the bond yield, Treasury bond yield, getting up to 14%. So it just shows how wild conditions are in the markets over the last 40 years or so. So, and the wildness, ironically, Jim, ties to the efforts by policymakers, economists, and central bankers to try and create a stable economy. And whenever they're injecting arbitrary amounts of credit, which they think is essential, it creates more instability and wilder markets. And so you went from an unprecedented 14 or 15% for the long U.S. Treasury bond in 1981, and then in Germany, where conditions are even more compressed, the yield on their 10-year note got down to less than 1% nominally. And in history, you never had interest rates at a nominal negative yield. And in history, you never, and going back, in 1981, you've never had the interest rate for the senior currency getting above 6.5%, and it got up to 14%. So we are in a world of financial madness because policymakers and central bankers are absolutely, they're mad, foolish, stupid, and have the power to keep pushing theories that don't work, and markets are always adjusting for it. So I'm glad to be kind of alive and alert and watching this, and particularly as a financial historian, to be able to put this, Jim, it's madness, and to put it in perspective. It is absolutely a privilege to be alert to what's going on.
Bob, thank you so much for chatting with us.
Yeah, Jim, good to be with you, and looking forward to next week.
My guest has been market historian Bob Hoye. He's the chief investment strategist for chartsandmarkets.com. If you have any questions for Bob, he'll gladly answer them for you if you send them to info@housestreet.com. Our YouTube channel is Talk Digital Network. Find us on Twitter @House Street. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HoweStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HoweStreet.com radio is a production of House Street Media Incorporated.